Welcome! You're watching Crypto Pump, your reliable compass in the world of digital assets. Here, we break down complex topics in simple terms, share time-tested strategies, and help you walk the path of crypto trading with confidence. Today's episode isn't just a video. It's a key to understanding one of the most powerful tools on the market. It's going to be interesting. In this episode, we'll take a deep dive into futures trading on the Bybit platform, a powerful tool that allows you to profit from both rising and falling markets, with leverage of up to 100x. You'll learn how to properly open long and short positions, how to use limit and market orders, and how to set stop losses and trailing stops to protect your capital. We'll walk through real examples, explain the mechanics of liquidation, and share tips on how to trade smart, even if you're just starting out. This is your first step toward confident futures trading. Want to not just understand futures, but confidently apply strategies in real trading? Then make sure to subscribe to our Telegram channel. There you'll find exclusive guides, tips from experienced traders, and an active community ready to help in any situation. The link is in the description. Check it out, it'll be worth your while. What are futures and how do they work? Futures on Bybit aren't about buying the cryptocurrency itself. They're contracts with the exchange, where you place a bet on where the price will go. Imagine you're making an agreement. I'll buy Bitcoin at today's price later. If the price goes up, you earn the difference. If it goes down, you take a loss. The key point is, you don't need to own the coin. You're simply trading its price movement. This gives you flexibility and the ability to profit from both rising and falling markets. Futures were invented by farmers to know in advance how much they would earn from their harvest. For example, a farmer agrees to sell wheat at a specific price by the fall. The market price might rise or fall, but the agreement stays in place. The farmer is certain of their income, and the buyer knows how much they will pay. In crypto, this idea evolved into a different format. You don't hold the asset, but instead bet on its movement, either up or down. On Bybit, futures are a way to respond quickly to the market. You don't spend money buying crypto and wait for its price to rise before selling it. Instead, you enter into a contract with the exchange. If your prediction is correct, you make a profit. And if not, you only lose what you staked. For example, if you're confident that Bitcoin will rise, you open a position, and when the price increases, you take the difference. Or, you wait for a price drop, borrow Bitcoin from the exchange, sell it, and then buy it back cheaper. Your profit is the difference. This isn't regular trading, where you become the owner of coins and hold them until they grow. Here, you don't physically receive crypto. It's a bet on the future, where you can earn on both market ups and downs. That's why futures are called trading air. You hold nothing in your hands, only agreements and calculations with the exchange. What's your experience with futures trading? Share in the comments. We'd love to know who's already in profit and who's just starting out. Let's find out together whether it's really true that 90% of traders lose their deposits, or if the reality is more nuanced. Your stories might inspire others. Long and short. How to earn on price changes. In futures trading on Bybit, there are two main strategies, long and short. A long is when you hope the price will rise. You open a position expecting Bitcoin to become more expensive. If everything goes as planned and the price does indeed rise, you close the position and take the difference between the old and new prices as your profit. It's similar to regular trading, where you buy low and sell high, but here you don't physically hold Bitcoin. Everything happens through a contract. A short is when you believe the price will fall. You borrow Bitcoin from the exchange, sell it immediately, and then, when the price drops, you buy it back at a cheaper price and return the loan. The remainder after that is your profit. For example, you borrow Bitcoin, sell it, wait for the price to drop, buy it back cheaper, and repay the loan. The difference stays with you. This way, you can earn even when the market falls, which is something you can't do in regular trading. Futures differ from simply buying cryptocurrency in that long and short positions, allow you to profit from both rises and falls. In regular trading, you buy coins and wait for them to increase in value, so you can sell. But here, if you're confident the price will drop, you can open a short and make a profit. This makes futures a convenient tool because you're not idle when the market is falling. But it's important to know, shorting is more complicated and riskier than going long. When you're waiting for a rise, the price can go up indefinitely, and your profit increases. With shorting, however, the drop has a limit. The price cannot go below zero, but if the price suddenly starts to rise, you could lose much more than you expected. That's why you need to be more cautious with shorts and have a solid understanding of the market to avoid being left in the red. Let's break down the next stage, how to start trading futures on Bybit. When you're ready to trade futures, Bybit is a convenient platform for such trades. Here, futures are used for short-term positions where you react quickly to market changes. To get started, you need to go to the derivatives section on the Bybit website or app. This is the place where all the tools for futures trading are gathered, and this is where you'll open your contracts. Next, you choose the type of contract. Perpetual USDT. This is a popular option because it's tied to the stablecoin USDT rather than real coins, and it has no expiration date. After that, you find the trading pair. For example, BTC USDT. This means you'll be trading Bitcoin against USDT. It's simple. Choose a pair, and the terminal will open where you can start working. Before opening a position, you need to transfer funds to your futures account. You have a main wallet on Bybit where your funds are kept. From there, you transfer the required amount, for example in USDT, to the futures wallet. This is done in a few clicks. Go to the assets section, choose transfer, specify the amount, and confirm. Once the funds are in, you're ready to trade. Bybit is great for futures because the terminal is user-friendly and intuitive. You can easily set up everything you need. Open a long or short, set stop loss, or take profit orders, and I'll explain that in more detail soon. It's a very convenient exchange for managing risks and profits. This makes the platform suitable even for those just starting to get into futures. Also, through my referral link, you can register and receive bonuses, up to $30,000, which will be useful to kickstart your trading. The link will be in the description. Use it to get your bonuses right away. And so, the next stage is leverage, how it increases both profit and risk. Leverage in futures trading on Bybit is the ability to trade an amount larger than your own capital. Imagine, you have $1,000 and you take leverage of 10x. This means the exchange adds another $9,000 and you open a position of $10,000. You enter into a futures contract, for example with Bitcoin, and now any price movement works on this increased amount. If you open a long position with this leverage, you are betting on the price increase. Let's say Bitcoin is priced at a certain amount and you enter the position. When the price rises, your profit is calculated from the entire contract amount. $10,000. If the price goes up by 10%, you earn $1,000, even though you only invested your $1,000. Without leverage, you would have earned 10 times less, only $100. Leverage multiplies your profit, making it a powerful tool for traders. But there's a downside. If the market moves against you, losses are also magnified 10 times. Let's take the same example. You opened a long position with 10x leverage on $10,000. If the price drops by more than 10%, say by 12%, then your $1,000 won't cover the losses. The exchange automatically closes your position. This is called liquidation. You lose everything you invested because there isn't enough money in your account to maintain the contract. So, with leverage, it's important to understand the risks. If you don't know how to manage them, you can quickly lose your entire deposit. Without a proper approach to risk, futures can become dangerous. For beginners, it's better to start with lower leverage, such as 3x or 5x. This way, your losses won't be as large if the price moves against you. Also, Bybit has a calculator that helps you calculate the liquidation point, the price at which the position will be automatically closed. This is useful to know in advance where your risk becomes critical. Now let's break down what margin is, how it affects your trading. Margin in futures on Bybit is the money you invest in your position to open a contract. When you trade with leverage, the exchange gives you additional funds, but part of the amount, your margin, must be in your account as collateral. There are two types of margin, isolated margin and cross margin, and they affect your risks and deposit differently. Isolated margin means that you're only risking the amount you've allocated for a specific position. Let's say you have $10,000 in your account and you open a contract with leverage, investing $1,000 as margin. If the market moves against you and the position gets liquidated, you lose only that $1,000. The remaining $9,000 in your account stays safe and is not involved in this trade. This is a convenient option because your losses are limited to one position. Cross margin works differently. Here, your entire deposit is used as collateral. Let's take the same $10,000 in your account. You open a position with $1,000, but if the price moves against you, the exchange can take money from your entire balance to keep the contract open. If the losses exceed the available funds, you lose all $10,000. This is riskier because one bad position could wipe out your entire capital. For beginners, it's better to choose an isolated margin. It protects the rest of your money in the account, and you're not at risk of losing more than what you allocated for one trade. With cross margin, the chances of losing your deposit are higher, especially if you haven't yet figured out how to manage risks. Choosing margin is an important step that helps you control how much you're willing to stake on each position. Next, we come to a very important point, without which you won't be able to earn consistently, and that is risk management. Risk management in futures on Bybit is the skill of managing your positions so that you don't lose your entire deposit. Without it, trading becomes dangerous, especially when you use leverage or open large trades. It's not just a useful skill, but a mandatory part if you want to earn consistently and not risk losing everything after a couple of bad trades. When you trade futures, it's important to understand that your money is at stake. If you don't know how to control risks, one mistake can lead to the liquidation of your entire account. For example, with 10x leverage or cross margin, losses grow quickly, and without the right approach, you can lose everything you invested. Risk management helps you decide in advance how much you're willing to lose and how to protect your capital, so you can keep trading even after losses. For this, you need to understand the tools available on Bybit. You can use stop losses, which we'll talk about in this video, to limit your losses, or choose an isolated margin to risk only part of your deposit. But the most important thing is to learn the basics. Want to learn how to manage risks and protect your deposit even in the most volatile market conditions? Then join our Telegram channel. There you'll find practical risk management tips, proven strategies, and support from a community of traders. The link is in the description. Don't miss your chance to level up your skills. Next, let's talk about the market and limit orders, what they are and how to use them. Market and limit orders on Bybit are two ways to open a position in futures trading. They are necessary so that you can enter the market on your own terms, choosing between speed and accuracy. Each of them has its own purpose, and it's important to understand how to use them effectively. First, we have the market order. This is when you open a position right now at the current market price. You simply choose how much you want to invest. For example, 0.1 Bitcoin, and click the button. The position is opened instantly, but for that, you pay a small fee, say $3, roughly speaking. But it's convenient despite the fee, especially if the market is moving quickly and you don't want to miss the moment for a long or short. The key is that you enter immediately, without delay, at the price available at that moment. The second method is the limit order. This is a different approach. You set the price at which you are willing to open a position and wait for the market to reach it. For example, you want to buy Bitcoin at a price lower than the current market price, or sell it higher. You place the order at a specific price, and it will only be executed when the market reaches that level. This gives you control over the entry, but if the price doesn't reach your set value, the position won't open. The limit order is great when you want to enter the market more precisely and are not in a rush. There are also different ways to set up orders. You can specify the amount, for example, 0.1 Bitcoin, or the sum, say $1,000. You can even set margin, and the system will calculate how many Bitcoins you will receive. Finally, let's talk about stop loss and take profit and why they are important. Stop loss and take profit are tools that help you manage your positions in futures trading. They are necessary to set limits in advance, how much you're willing to lose or how much you want to earn. They are an important part of risk management, so that the market doesn't catch you off guard. Stop loss is an order that automatically closes your position if the price moves against you. You set a level at which you are willing to exit to limit your losses. For example, you opened a long position, but the market started falling. If the price reaches your stop loss, the position closes, and you lose only what you had decided in advance. This protects your deposit from large losses, especially when you can't constantly monitor the market. Take profit works the opposite way. It locks in your profit when the price reaches the desired level. You set a target where you want to exit with a profit, and as soon as the market hits this point, the position closes automatically. For example, you opened a long position, and the price rises to your set take profit, which locks in your profit, preventing the market from reversing and taking it away. This is convenient to avoid missing the moment when you're already in profit. These orders can be set right when you open a position, or added later if the market is already moving. For example, you enter a long position and see that everything is going according to plan. You add a stop loss below your entry and a take profit above. This way, you keep control over the situation. Losses don't grow infinitely, and profits are locked in on time. They are essential for making trading calmer and more predictable, especially for beginners. What is a trailing stop and why is it needed? A trailing stop is a special order that helps you lock in profits when the price moves in your favor. It works differently from a regular stop loss. Instead of a fixed point for closing, a trailing stop follows the price, adjusting to its changes. This is a useful tool to ensure you don't miss out on profits if the market has already gone in your favor, but might reverse. Here's how it works. You open a position, for example a long position, and set a trailing stop with a specific distance from the current price, let's say 3%. If the price increases, the trailing stop moves up along with it, remaining 3% below the highest point. If the market reverses and falls by 3%, the position is automatically closed and you lock in the profit. This means you protect your earnings without losing them due to a sudden pullback. For example, you enter a long position and the price starts rising. The trailing stop follows it. If the price peaks and then drops by the set percentage, it triggers and closes the position. You don't lose everything you've earned. You keep the majority of your profit. This is especially important in futures, where the market can change quickly and you don't want to end up empty-handed after a good rally. What are conditional orders? How to trade based on market signals. Conditional orders are a way to open a position automatically when the market hits a level you've set. They only trigger when specific conditions are met, which you determine in advance, helping you enter the market without needing to stay glued to your screen. This is a tool for those who want to catch the right moment without extra effort. Here's how it works. You set a trigger price, the level at which the order will activate. For example, you're waiting for the market to break upward, so you set a conditional order for a long position. If the price hits your trigger, the position opens by itself. Alternatively, you might think the market will fall and set a short position with a trigger for a downward move. As soon as the price hits that level, the order is activated and you enter the position. Conditional orders are useful for making your trading more flexible and precise. You can plan your entry in advance based on your forecast and not miss the opportunity if the market moves while you're occupied. This is especially useful in futures, where prices change rapidly and timing can be crucial. Conditional orders give you control and automation in one. And now, a bonus for the most dedicated viewers. If you've made it this far, here's some extra value. We'll break down a few more useful tools to help you trade with even more confidence and efficiency. Don't go anywhere. It's going to be good. The first tool is margin addition. If your position is close to liquidation, you can add more funds to push that point further away. For example, you invested $500, but the price moved against you and liquidation is near. You add another $500, and now the total margin is $1,000. This shifts the liquidation level further, giving your position a chance to hold and potentially reverse the market in your favor. The second option is multiple take profits. You can set not just one profit target, but several. For example, you opened a long position and want to lock in profits in parts. The first take profit closes a third of the position, the second one closes another third, and you leave the rest in case of further growth. This helps you secure part of the profit early, while keeping the position open for more potential gains. You split the trade into 3 parts and close them gradually. There are also bots for automation. Bybit offers a futures grid bot. It automatically opens and closes positions according to a set price grid, earning from small market movements. There's also copy trading. You connect to the strategies of experienced traders and replicate their trades. Friends, now you know how to trade futures wisely and avoid the most common beginner mistakes. Want even more helpful tips, fresh market analysis, proven strategies, and trade breakdowns? Then be sure to check out our Telegram channel. The link is waiting for you in the description. If you found this video helpful, leave a like, share it with your friends, and drop a comment to let us know what you think. See you in the next episodes. It's only going to get more interesting.